Well, last year was another very difficult year for emerging market currencies. Our MUFG Emerging Market FX index declined by about 6%, and that was the fifth consecutive year of calendar losses, taking cumulative losses over that period to almost 20%. So we have seen a sustained period of emerging market weakness. However, if we look at recent price action over the last couple of months, we are starting to see a turn in a more favourable direction for emerging market currencies. There have been two fundamental reasons why investor sentiment towards emerging markets is starting to improve. Firstly, developments in China are moving in a more positive direction. Policymakers there have made the decision to shift away from their zero COVID policy stance. And while that will lead to some economic disruption in the short term, once we get past the peak of the current COVID wave, we expect China's economy to reopen more fully and demand to bounce back more strongly in the second half of this year. And we think that's going to provide a positive tailwind for Asian currency performance. And on top of that, emerging market currencies which are tightly linked to China demand, such as LATAM currencies in Brazil and Mexico, should also outperform in that environment. And the second fundamental reason, which is becoming less negative for emerging market currencies, is the ongoing shift in Fed policy. At the last Fed meeting, the Fed delivered a smaller rate hike, 50 basis point hike. And we do think that the direction of travel is towards the Fed bringing an end to their rate hike cycle in the first half of this year, which we believe will provide further relief for emerging market investors and help to lift emerging market currencies.